we're in a very strange moment in time in the markets in general, in the metals space, I think. And so I've tried to capture why I think it's so strange by sort of looking longer ago, in recent past, what's happening now, and where that might take us. It's all a bit arm wavy. I do think that there is a good decade ahead for especially metals that are needed, like base metals as a whole, that are needed for the green transition. But the near term is very difficult to understand. So that's why I say I don't actually know when and what shape that this is going to manifest. But I do think that there's good opportunity ahead. Okay, so like I said, I want to talk a bit about the past, the recent past, the longer ago past, the recent past, the present, and then what that means for the future. And the question that I'm trying to answer, or that I have decided is the most pertinent, is how are things going to look on the other side of this tightening cycle? And by that I mean sort of what will investors be interested in when we get there? Because I think that will determine in large part the shape of this metals market to come. Okay, so let's look back. So before the great financial crisis, before the Fed became quite such a dominant force in everything markets related, I would generalize to say, and obviously things changed, right? There were different moments in time and different things were important to investors at different moments in time, but I would generalize to say that outside of bubbles, like the tech bubble, fundamentals mattered more. There was a bit more rationale-based investing. And for those of us who are interested in metals, that meant that metals markets did move when economic and supply-demand setups meant that made sense. So investors moved into metals markets in those sort of classic ways that we wish were still the case. You know, when rising growth supported commodities and inflation also supported commodities and gold. There were classic patterns that we liked, and they all made sense back then. There was also, I think, a clear focus on gold equities for the reliable leverage that they gave when gold worked. And that made gold equities somewhat unique because there weren't that many equities out there, categories of equities, that provided high likelihood speculative returns. So when gold markets worked, you could invest, and yes, it's still speculation, it's still exploration, or it's still, betting on the price of gold, but if the price of gold was generally well set up, there was a lot of investor buy-in to the idea of gold being a somewhat unique opportunity for high risk, high return investing. And so that's what this chart shows. That created the leverage that we all talk about and that we all wish we had experienced over the last little while, but haven't experienced very much over the last little while. But that's what caused it, is because gold and silver stocks were known for offering that high likelihood risk return when, in the speculative category, when the setup was correct. Also in the past, I would say, when investors were interested in metals, that would combine with the fact that there were fewer impediments to development than there are today to create supply response when there were increases in demand. And of course, China's growth in the 2000s is the perfect example of this. As the ramp up in commodity demand became apparent, supply pretty much increased in lockstep. And you can see those bars up and down, sure, through the 2000s, but yeah, and there were some years that were weird one way or the other. But really, supply answered demand growth, even though demand growth was very dramatic in the growth of China years. But supply could respond because investors were there, therefore capital was there, permitting wasn't really drawn out, supply could respond. You can see that the deficit in the copper market has been different in recent years because supply has not responded to increases in demand. And I'll get into that more later, but I think in the past that relationship was a little bit easier. Okay, so that was all, I think, past before the great financial crisis. Then we get to the crisis and the era of the Fed, right? And that's certainly what we have been in for 12 years now, which is a long time. And since the great financial crisis, increasingly, the Federal Reserve has become viewed as the protector of the stock market. That seems normal now. That's like, at least, especially a year ago, that was just that had become just presumed. Yes, that's what the Federal Reserve does. It supports the stock market. Of course, that is not actually the Federal Reserve's mandate. The Federal Reserve's mandate is to control inflation and protect unemployment. But those things were not particularly pressured once we came out of the darkness of the great financial crisis, and except for a fairly short moment, really, in the COVID crash. And so it became known as the protector of the stock market. And because of that, investor focus, I think, really changed. The Fed backstopped risk, so investors piled into risk. And that has been a dramatic transformation in what investors are interested in the market as a whole. And I think it's had major implications for the metals space, because it turns out metals didn't get to play a role in that so much. So speculation soared, sort of classic rationales, fundamental arguments dimmed relative to tech all the time, new arenas that cropped up, cannabis, crypto, meme stocks, crazy things like monkey NFTs, whatever it was. The Fed supported all of it, and a lot of things worked. And then the need to come up with well-evidenced rationales for investing in a particular sector also dimmed, because everything worked. So why bother diving into the rationale for uranium or copper or whatever it might be when you can just, buy the freaking index and you're going to do just fine. So the way that the Fed supported the stock market and supported risk acted, I don't think intentionally, but it ended up really driving interest away from metals that require investors to care about those fundamental rationales. Okay, so still in the post-Great Financial Crisis period, the Fed could do this because its mandates, like I said, were not pressured. And I think the fact that the Fed moved to support the stock market in late 2018 by cutting rates, when, it's not like it was a dramatic, it was a less than 20% market slide, and yet they moved into cut rates. That really reinforced this new world, this new view of the Fed. And then, of course, COVID hit, and bam, did that ever reinforce this new model of thinking, this new investor outlook. Of course, meanwhile, metals went into a deep, dark bear market for reasons that we all understand, I'm sure, quite well. There was a supply over response to that China growth story. And then the complete failure of mining stocks to reward investors during that bull market, especially of the 2010, 2011, because of bad corporate decisions. That meant that miners got punished. So metals went into a long, dark market. And as part of all of this focus on speculative investing, that special place that gold stocks used to hold as offering unusually high likelihood speculative returns, that diminished, because all of a sudden all kinds of things offer highly speculative returns. So you don't have to invest in gold equities as one of the only things that gives you that high risk, high return opportunity. Instead, you can all kinds of risky assets were handing out returns. Of course, with risk, I mean, we all know that AMC is not where this particular chart shows it anymore, right? But that's the risk return balance. But I really think that role that gold equities had played for a long time has been diluted. There's so many other options if you want to be a speculator. There's been so much speculative investing that gold stocks aren't offering the leverage that they did because investors aren't funneling to them for that opportunity. Okay, so that brings us to today and this moment that we are in, which is clearly all about inflation and tightening. How far do we have to go? I mean, it's hard to know. Certainly, central bankers are not done tightening yet. We've heard that message very loud and very clear. And I mean, I can sort of argue both sides of this story, right? The energy crisis in Europe is very inflationary, but it's also not, because, smelters closed down and that reduces manufacturing, and businesses, I mean, you can visit Twitter for just a few moments and you see how many businesses in Europe are saying that they won't be able to pay their electricity bills and therefore will shut down, right? So energy prices are in the moment very inflationary, but they're also not. Demographics, I think, is an important consideration. They're certainly keeping unemployment down. Remember, the Fed has two mandates, inflation and unemployment, and demographics are keeping unemployment down because so many people retired. So many working age people pulled their retirement forward slightly in COVID or just got to retirement age of late because of, that baby boomer situation. And so the unemployment remains very low, and that's really important because we have a very consumer-based economy, and if people still have jobs, they keep spending, but they do tighten their belts a little bit when inflation is making everything cost that much more. So again, I can kind of argue that one both ways. China is a huge question here. How bad is it going to get in China? This is a very big question to answer when you try and figure out how bad things are going to get globally in the next little while. I have a pretty good confidence in the North American economy to weather this tightening storm with a reasonably soft landing, but the China question certainly matters, and we don't know yet what the answer to that was going to be. Real liquidity is an important factor for the stock market, right? What can people invest in stocks? Well, the money that they have freely available, and mortgage costs definitely matter to that equation, and guess what? They went up a bunch in Canada just the other day. So I can look at this inflation question and argue it both ways. Certainly, like I say, the central bankers have made it very clear that they are going to do at least one more big hike, probably two. So we'll see. When tightening ends, and I do think that we're likely to get to that point at the end of the year, a hike in September, a hike in November, then let's see where we're at. We get back to that question that I started with, which is, what will investors want when this cycle tops? Will this speculative focus that has just grown and grown and grown since the great financial crisis and was redoubled after COVID, will that return to the fore? Will that come back and be the thing that investors do? Or will fundamentals matter more? And I think that that depends on things that we don't have the answer to yet. How all of this plays out for the economy, how all of this plays out for the markets, and whether the Fed is seen to act as supporting the stock market through those questions. If the Fed is seen as supporting the stock market, then we're sort of back in the Fed's backstopping risk, and we'll probably go back to speculative investing. If the Fed tightens until inflation is truly in hand, and notwithstanding, even though that hurts the stock market along the way, then I think we do end up in a slightly more rationales or fundamentals-based investing paradigm after this tightening cycle, which would bode well for metals. So I'll get back to, I have a little matrix that tries to put those things in some sort of color-coded sense at the end. So if that's confusing, I'll get back to it. At the end of the day, metals make sense, and I started this by saying that I'm very bullish on metals over the next decade because there just isn't enough of the copper, the nickel, the lithium, the silver, the uranium that we need for growth in general, and particularly for growth within a green transition. And yes, a green transition absolutely goes on pause when the world enters a recession. I get it. But it's not going to stop. I think it's a force that is unstoppable at this point. And so even though it pauses, the paradigm shift level increases in demand for these metals, they are still coming at us. They're really significant. They're still coming at us. And when I was talking about the long ago past, one thing that I mentioned is that it used to be that supply could respond to increases in demand because miners did that. There was investor interest. Permitting timelines were not a complete obstacle to building new mines. That is, all three of those things are now changed, right? And that means that there has not been supply response in the last while as green demand has climbed. So we have all of these charts, and I'm going to run through a few of them here, showing the increases, the incredible forecast increases in copper demand, in nickel demand, in lithium demand. And so lithium's getting some response, but really there hasn't been supply response, and it's because there's no investor interest in metals, so there's limited capital available to make these things happen. Management teams are mandated to be conservative, right? The management teams that screwed everything up so badly in the last metals market all got the punt, and those who came in were mandated to be conservative And so they haven't been focusing on growth. And then there's the very long and uncertain permitting processes that are now just the thing in our industry. And so there hasn't been supply response. So that only exaggerates the need here. And these are very quick glances at some of these metals supply-demand scenarios. I mean, again, these could pause somewhat or be shifted out somewhat if China really struggles, as it might over the next while. But nonetheless, the supply-demand gaps are dramatic, right? So, I mean, the middle of this decade will see the largest deficit ever in the copper market. The middle of this decade is very soon, right? Like we're not talking about, oh, in 10 years, the copper market's gonna have some trouble. No, this is like very soon we are going to have a significant deficit in copper because there's been no supply response. And what changes that? Well, a significant increase in price to the point that it catalyzes political action, I think, which references that permitting issue. I mean, silver just, if solar panels were built the way that they're built now, the EIA's projection for increased silver or solar panel demand would eat up all of silver supply within the next decade. Except that solar panels are actually going to start using way more silver. So solar panels alone are going to use up more than all of the silver that we have available. And it turns out there's a whole bunch of other industries that need silver, so there's nowhere near enough silver either. Oops. Uranium is its own market, right? There's stockpiles sloshing around that still keep coming out of Japan. There's more questions there. But at the end of the day, I think anybody who reads the news is aware of the nuclear power renaissance that we're seeing, sparked by, or pushed ahead a bit by, of course, the Russian invasion of Ukraine and the energy crisis in Europe. Of course, there's actors out there who are very much trying to create a uranium bull market, and Sprott is the leader amongst those. And at the end of the day, it's been in a bear market for so long that we need higher prices, even from where we are today, considerably higher prices to incentivize the new mine supply that is needed to fill in those blue bars that are what we don't have. And then there's lithium. Lithium is already up 400%. Lithium prices are up 400% over the last, 12, 18 months, whatever the number is. But we're still in deficit. We're going to be in deficit for another 3 years at least. And that's because lithium was this like little tiny market. Not very long ago, like 10 years ago, 15 years ago, there was like, lithium was used in ceramics and medical things, like it was not used in very much. And now so the demand growth in lithium is hard to wrap your head around. The scale of increase here is hard to wrap your head around. And that chart that's in the bottom right, what's important to notice there is that the blue bars, the dark blue are highly probable sources of new supply, but the medium blue and the light blue are not very likely. I mean, it all depends on technological advances and permitting and all of this, but there's no guarantee that the light blue, the very light blue is very uncertain. The medium blue, and yet the gap is still very dramatic. So I think that these are the reasons why I'm so bullish in the medium and long term. It's just a question of the shape in the short term that's hard. Oh, I love how that my emojis really didn't come through there. There's supposed to be some pictures that are apparently just empty squares. Anyways, gold, I don't see a lot of impetus for gold to outperform, certainly in the near term. Rates are rising, inflation is falling, so that means real rates are rising. That doesn't help gold. The US dollar is not helping gold either, and that's not likely to change in the very near term either. Gold can often piggyback on a broad metals bull market. That's not underway yet. As I've said, I expect it to happen, but it's not underway yet, so that's not going to be an early push. Geopolitics, I mean, that was supposed to be one of these emojis, because like they come, they go. There's been lots of geopolitical forces that you might have argued should have helped gold in the last little while that haven't had any staying power. So the question is, if we get a recession, Remember that gold does not work at the beginning of a recession, but it rises first out of recessions. So that would be the thing to watch if you're looking for a golden opportunity, I would say, would be to pay attention to the timing of that. And this is this matrix that I said I put together. So I think the shape of things to come depends on how much investors focus on fundamentals versus speculation once we come out of this tightening cycle. And it also depends on how deep or hard this recession is. And that depends in part on China. So if investors do return some of their interest to fundamentals instead of either just buying the index or being very speculative, that bodes better for sure for metals. And it bodes quite well for them if we end up in a soft to moderate recession. A hard recession, then metals will always slide with that recession, and then I think will start their sustained rise from there. If investors decide to go back to the speculative, frothy type investing that they've been doing for the last few years, that's harder, but we will nonetheless come up against these crazy supply gaps that are coming down the pipe. And so at some point that should make for explosive moves, which isn't my preferred path. I would choose a sustained gain over these explosive moments, the delayed explosive moments. But I think those are that's how I've tried to wrap my head around the outlook from here.